Many investors think 2026 will be a year of acceleration for the U.S. economy, with less policy uncertainty and, of course, that so-called one big beautiful bill bringing tax cuts. Our guest says those hopes may be a little exaggerated. Let's get more from Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers Solutions. Jack, thanks very much indeed. So far, of course, U.S. corporate profits, the U.S. economy holding up pretty well, despite signs of weakness in the job market. But you think there may be too much optimism about U.S. growth?
Yeah, there's a couple of things at play in here. And I think when you were talking about the impacts from the one big beautiful bill and a lot of that coming back in terms of tax returns to the consumer, you know, the idea, I think, is that people are expecting all of these tax returns to basically be spent. And when you go back in history and look at that, that's not the case. And especially during COVID, for example, we saw roughly 40 cents on the dollar was spent, and the rest of it was either saved or used to pay down debt. So, you know, there's certainly, I think, at the margin, it's going to be supportive. We're just not quite as optimistic when we start to look at some of these GDP estimates that are pushing north of, 2.7, 2.8. We're probably closer to, 2%, 2.25%, which is still a very good backdrop, but not quite as aggressive, I think, as some of the other people our competitors are pointing out here.
And when you look at the real estate market, you see weakness in rents?
Yeah, and I think that's part of the inflationary backdrop, right? When you start to look at a lot of the real-time pricing that's out in the marketplace, when you look at things like Zillow, apartmentlisting.com, some of the indices that we see coming from regional Fed banks, they're all pointing to the same thing, and that's continued slowing in that portion of the marketplace. And again, we all know there's a lag between that pushing through to the real data that's being used in the inflation prints, and as a result, we think that continues to put a downward pressure on inflation. So I think moving closer to that 2% target by the end of the year I think that's our base case scenario and should continue to play out.
What sectors of the market are you overweighting right now, Jack?
Yeah, I think we have a couple of things going on here, and the big one is really the uncertainty around the disruption regarding the AI trade. And so as a result, we're trying to stay at least neutral there. It's certainly a stock picker's market when you think about tech. You have some pretty big dispersion in returns. So the winners are having some really good numbers and the losers are having some really bad numbers. And unfortunately, some of that can cancel themselves out. So we're still trying to stay somewhat neutral tech, but it still seems like the cyclical portion of the market is going to be a key beneficiary of that AI trade, and we potentially could start to see some productivity gains kicking in, maybe some margin improvement there, and that really plays to the area of the market like financials, industrials, maybe to a lesser extent energy, and that's where I think we probably start to see the continued strength into the end of the year here. When
you say cyclical part of the market, economically sensitive stocks such as industrials, for example?
Correct, yes.
I mean, it's incredible. It's a thing we should look into further. It must be so hard to find an electrical contractor in the USA right now, or somebody to even, put in copper wiring for you.
And I think we're seeing that across the board with the general backdrop for the labor market, right? We're continuing to see slowing in the labor front. And if you look at all the posts that we saw last week, whether it was JOLTS, which posted job openings that were slower than expected, you look at the ADP number came in softer than expected, weekly jobless claims a little bit of an uptick. So when you kind of continue to go through these jobs numbers, you're certainly seeing a slowing in the labor market, on top of the idea that some of these big AI data center build-outs are kind of sucking some of these laborers back to that sort of the marketplace. And the immigration backdrop certainly not helping something like, for example, the real estate market. So certainly plenty of headwinds with regard to what we're seeing coming from the labor market side. And that partially goes into why maybe that growth backdrop might not be quite as supportive as maybe some think.
How about commodities? Copper, for example, or copper-related plays. I mean, I'm thinking about mining stocks. Freeport, McMoran would be an example, not necessarily that stock.
I think the backdrop for commodities is still pretty strong, right? I think you've got some supply and demand imbalances here. Part of that being driven obviously by the AI infrastructure build out, whether it's the data centers themselves or just the electrical grid, so to speak. But I think maybe something that's not quite as appreciated as much is the defense stockpiling that we're going to have to go through.
You're right.
A lot of these military upgrades are going to require these raw materials, and so from that perspective, the national security angle here, certainly can see commodity prices continuing to be supportive going forward, especially on the industrial side of the raw materials equation.
And just swinging back to tech, you are looking for companies that will specifically gain from AI, but you're less keen on the Mag 7 names. You're not overweighting those.
Yeah, I think what we're seeing with the Mag 7, last year, I think it was sort of the benefit of the doubt, and that started to change towards the end of the year where investors were starting to question the CapEx spend, and they wanted to see what kind of return on invested capital they would be getting. I think you can then take that a step further, and then the Mag 7 is certainly putting up some massive revenue numbers, but I think we're starting to question the potential for margin growth that might be coming back down a bit, and certainly that free cash flow number coming back down again. So when you start to compare those latter to the broader market, maybe that big, when you had the Mag 7, really the huge leadership on that front, it's coming more and more back in line with the marketplace. And as a result, you're seeing some of the re-rating that's going on there. So I think it's tough to make a play on Mag 7. You're going to have huge winners and big losers there. But at the same time, those wide moats, I think, are starting to kind of sort of come back closer to the broad market. And I think it's what we're seeing right now.
Jack, thank you very much indeed for joining us.
Thank you.
Jack Janasiewicz, portfolio manager at Natixis Investment Managers Solutions.